just take like 10 seconds before we start.
Okay. Good evening, guys. Welcome to today's session. We will be discussing risk management with Edwin. So maybe Edwin can just say hi first.
Good evening, everybody, and welcome to our session today.
Yes. So today, as I said, we'll be discussing risk management. So trading, as with any other business, involves some level of risk. And risk usually can be controlled in various ways, depending on the steps you take and how you understand that business. So for example, if you venture into any business such as real estate or any online business or even a physical one, you need to understand what is at stake every time you take a position or every time you put your money on the line. And that's the same with trading in this case. So in this short session, we're going to discuss on the steps that you will probably want to consider when you're trying to control for your risk. So you can't completely eliminate risk, but there are steps you can take to reduce that risk when it comes to your trading. But even before I continue, maybe Edwin can chip in with his idea of risk and what exactly risk is. Edwin?
So risk basically entails so risk is the inability to control the outcome. So if you cannot control the outcome of a particular situation, then it means that you're running a risk of losing something.
Yes.
Yeah. So yeah.
So yeah. Yeah, exactly. That's it. So it's like the probability of having an unknown outcome coming into place, either a good outcome or a bad outcome. So because you are not in control of that, then that's the level of risk you have to consider when making your moves. So in this session, that's what we'll be covering basically. There are steps traders can take to reduce the amount of risk that you are facing in your trade. So if you can go to the next slide. Yes, so many traders usually struggle to have consistency in trading because trading carries a level of risk that traders need to be cognizant about. So every time you take actions that are not favorable to the business of trading in general, then you have to expose yourself to risk. So there's this misconception that you can easily make money when trading the forex markets. But in the case where you have a probability of a high return, then the simple rule of risk is if there's a high return, then there's a high level of risk involved. So you need to take actions that enable you to mitigate or to reduce that risk so that you are consistently profitable or so that you have a positive expectancy in general. So this is important, and it's something that you need to consider when you are venturing into the business of trading in general. So it is important. You can aspire for significant profits, but there's one rule in trading that says you have to take care of your downside. If you are taking care of your downside, or if you're monitoring your downside or your probability of losses, then the upside will take care of itself, because trading usually has a binary outcome. Whenever you place a trade, you're either in the money or out of the money, depending on the rules and the strategies you've put in place. So I think Edwin can take it from here with regards to the first steps.
All right. Now, the problem, as you stated earlier, most people tend to overlook the process of earning money. So most people are fixated on the fact that they're seeking profit. So when you're fixated more on profit, you will in most cases overlook the process of getting there. And you therefore run a risk of putting your hard-earned money to risk. So as a matter of priority, you should ensure that as you trade, you're safeguarding whatever little money that you have. And if you can be able to apply the right knowledge to identify when and how to trade, then you'll be in a better position to have a chance to grow. So the whole idea is not to come into the market targeting to make huge sums of money within a short period of time. You should take this as any other business where you have to give it time and have your capital grow. So you're better off risking small bits of your capital or allocating your capital in very small bits to very many opportunities, while at the same time targeting to make small portions of profit in return, rather than risk huge portions of your capital, targeting to make a significant amount of profit. Yet, because when you have that approach, when you approach the market in such a manner that you put too much money or too much margin into very few trades, then your chance to grow in the market is diminished, or it's reduced quite significantly. And more often than not, you're likely to lose the entire capital or lose a huge chunk and derail you towards growing. So I don't know, have you ever noticed, Mzera, that if you dent your capital, or when you dent your capital with a very huge loss, it could be one trade or two trades or a few trades. Do you notice that it's usually quite hard to get back to the same level, let alone making a few steps further?
Exactly. It's called the risk of ruin, where you get to a point where it is close to impossible to recover your account because of the losses that it has taken. So in most cases, you'd rather you end up either attempting to top up or just reducing your risk and trading with what you have left, because at that point, it becomes almost an improbability that you can continue to trade that account back to break even. So it's usually called the risk of ruin. And in most cases, traders' behaviors change when you take a huge hit on your account. Because if you're following some rules and you find yourself you're not following those rules, or if you're not following rules, then now you try to make yourself follow rules, and then you become impatient with your strategy. Because at the end of the day, you have to learn how to eliminate your emotions from the process. You've talked about the process very well. You need to have a process that ensures that in the long run, the steps you take to put trades and get out of trades is sustainable enough. And if you're risking large amounts in every single trade, then there's going to be that one event that is going to almost entirely clear your account or leave a huge dent in your account. So then you have to ask yourself, if I'm taking huge risks, is it going to be sustainable in the long run? Because trading is a game of sustainability and survival.
Yeah, and again, you've brought a very strong point, because when you make a huge loss with, let's say, like two trades or even one trade, most traders tend to like overtrade in an attempt to recover whatever amount they've lost, and that may snowball to have you lose even much more money. Yeah, so
Yes.
Yeah, so that happens quite often.
Yeah, because your emotions and how you behave is also directly correlated to the amount of risk you're taking, because it affects your decision-making process. And in trading, your decisions directly impact your balance sheet. Yeah. So it's like in no other business where there is a direct correlation between how you behave as a person and how your balance sheet would look like at the end of the day.
All right. So the first thing that traders need to put into consideration once they begin to trade online is to first learn. So all brokers, including FXPesa or EGM Securities rather, you'd get an account called demo account, and this account enables you to learn and test different things. So for example, you can test different techniques of how to spot opportunities. And once you have trained yourself, and once you've tested that technique over and over again, then you can be able to gauge whether that technique can actually help you to trade on a live account. You can be able to know whether that technique is sustainable. So once you've learned, then you need to adopt a strategy or a way to filter out potent opportunities. So it's all a matter of establishing a plan or a checklist whereby once certain events or once certain occurrences manifest, it's at that point then that you'd consider to take a position in the market. So a strategy is basically a simple technique or a checklist where you have clearly stated triggers. So you are basically awaiting for these triggers to happen, to then know that by getting into the trade, once they happen, then probability is high to win or to make profit on a trade.
Yeah.
So some of these triggers could be, or what would constitute a strategy would be something as simple as identifying the direction of the market. Because this market, Samson, is all to do with price speculation, right?
Exactly.
Yeah, so if you can be able to determine with a decent level of certainty where the price is likely to move towards, then you're halfway towards identifying the right opportunity. So the other thing can be identifying a key level in the market. So in trading, we have cases where a price would sort of form a psychological barrier, either on the upper side of the market or on the lower side of the market. Or indeed, if the price is on a long-term upward move, you may notice particular patterns manifesting on the chart.
Yes.
So these key levels are called support and resistance. So the point is, when the market comes back, or when the price comes back along these levels, they sort of act as sweet spot zones where price is likely to shoot, either to the downside or to the upside. So identifying such levels and waiting until such a time when the market has come back to retest such levels then would offer you a high probability to predict the impending movement in price.
Yes.
Another trigger that you might add in your strategy could be an indicator. So indicators are mathematical algorithms which are embedded on the platform. And they basically show the movement or their reactions relate to how price is moving or how price is likely to move. Another thing that you can consider when coming up with a strategy is candlestick patterns. So there are so many candlestick patterns, and an example of a pattern is a case where you may have candlesticks indicating rejection of a particular zone or a particular price level. Another thing that you can also consider is chart patterns. I mean, there are so many chart patterns. For example, there are cases where you may find price forming a wedge, a rectangular shape, a triangular shape, or even double tops or double bottoms. So these are some of the things that you can integrate in your trading in order to get a confluence. So the whole idea about the strategy is to help you to focus. So you're waiting for convergence of these triggers to happen almost at the same time. And once that has happened, then you will be increasing a chance to get the right opportunity.
Yes.
So the bottom line is, yes.
There's something you've mentioned about confluences and probabilities. Yeah. And when you're coming up with a strategy, all you're trying to do is understand, are there specific occurrences or phenomena that happen in the market repeatedly and consistently enough for you to know this is a high probability event that can occur again? For example, the first example you've given is taking buy positions only in an uptrend. Yeah. If we look at the stock market, for example, we've had an uptrend from mid 2020 on the daily charts, from mid 2020 of April all the way up to January this year. Yeah. So that's an occurrence where a trader can tell themselves, by looking for buys only, then I'm able to be in a better position to be right when I'm taking a trade, because more often than not, the market is in one trend for a very long period of time. Yeah.
Yeah.
So those confluences then add up to the probability of you being right. And in most cases, your strategy doesn't have to necessarily be 100% right. It just has to be right more times than you're wrong.
In fact, you can never be right all the time. So, and I mean, you don't have to be right all the times. So the whole idea is to ensure that when you're right, you're making more money. So it's about being right as many times as you can. And when you're right, you want to win more money. And when you're wrong, you want to lose the least amount of money possible. Yes. Yeah. So that's the whole idea.
Achieve a positive expectancy.
Yeah. So from this chart, Mzera, what does this chart tell you, or what can you deduce from this chart?
So first we have a ranging market. The market is in a sideways movement, sort of a sideways movement. We have a support zone. So the support zone can be used to identify that the market is ranging. And then we have prices bouncing off that support zone and forming some patterns at the base of that support zone. And then we also have a stochastic indicator. So in this case, you can see that there is some confluence from the fact that the market is sort of bouncing off a specific level every time it gets to that level. And also the stochastic can be added as a confluence to confirm for you that actually we might have a bounce off this region. It might be an area where there is a potential buy the next time you see the market approaching that level.
Yeah. So this is just but an example of a case where we have a confluence or convergence of triggers. So in this case, you will notice that these three instances, we've had price reversing to the upside upon reaching this zone. So ideally, by marking this zone, on the basis of those three reversals, you'll be wanting or you'll be looking to use that level as a point of reference as the price continues to unfold. So when the price dropped back for the fourth occasion, you will notice that not only did we have a candlestick pattern. Do you notice that, Mzera?
Yes.
So yeah, we have a candlestick pattern. So we have a rejection candlestick pattern.
Yeah.
So that is one of the triggers. Then when you look at the indicator at the bottom, that indicator is, or the zone marked by the yellow rectangle is indicating to us that the price is in an oversold state. So the indicator also tells us that going forward, the likelihood of the price to rise is quite high. And
yes.
Yeah, and again, going forward on the far right extreme, again, you will notice that after the price had shot up and dropped back again along the same level, again, we have another candlestick pattern. So this candlestick pattern is indicating the rejection of the movement to the downside. And again, we have an additional confirmation on the basis of our indicator. So this is the kind of picture that you'd want to have. So once you've tested several indicators, or let me call them triggers, then you'll be able to know what kind of picture you'd want to have for you to consider taking an opportunity in the market. Yes. Similarly, here we have another chart. So again, I'd pose the question, what would this chart, what is it relaying to you?
I think, Edwin, it's taking me back to the idea of having a confluence of ideas. For example, in this case, we know that when the stochastic goes above 80, then we should be looking for potential sells. We know that the price, if it goes to a level of resistance, then there's a possibility of it turning. And we also know that if we start seeing rejection levels at some point, then prices are likely going to turn. So you see, there are three confluencing ideas that give you a higher probability from a technical analyst perspective.
Yeah, and not only that, linking it to risk now, you will notice that since you know the point at which, or the area where you'll be looking to get into the trade. So like in this case, we are looking to enter into a sell position along this zone. So you will notice that by selling at that point and setting your stop loss somewhere above that zone, you've already reduced the level of exposure, because if that trade fails, so we are not saying that the trade cannot fail. Should it fail, the question you should be asking yourself, how much of your capital are you likely to lose? So in this case, we are likely to lose very little by setting our stop loss above the yellow marker. But as you can see, price will move significantly to the downside. So whatever we will be targeting to get is worth the risk that we are taking.
Yes.
Right?
Yes. So yeah, exactly. Because now you know that.
Yes.
You know that if we repeat this process a couple of times,
yes,
based on these high confluence ideas, then in more cases than not, we are going to be right.
Yes.
So and that's the whole idea of having the strategy in place.
Yes. And if you are right, then you can be able to milk that opportunity and generate sufficient amount of money, which will then allow you to take many more opportunities in the future. So that's the whole idea. Yes. You can have like one trade where you've won $100 or let's say $200, and you are risking like 50 pips. And by winning just one trade, you can afford to lose 3 times and almost be at the same level, or at least one step ahead. So the whole idea is, are you able to get, or can you be able to get into a trade at a point where the market is just about to reverse in the opposite direction, so that you can be able to minimize a case where your trade will be on the losing side with a wide range or with a huge amount of or with a wide margin into the losing side. So that's the whole idea.
Yes. So I think that brings us to the point of how you treat your stop losses and take profits, because that compensates for the accuracy of the strategy. For example, if I am only right 4 out of 10 times when I'm trading, then it means in those 4 times, I should be able to make more than enough to recover my profits, to recover my losses, sorry.
Yes.
So if I'm making 20% or okay, $20 in a trade, and if when I lose like $5, then I know in my strategy, in as much as I have a higher loss rate, I know that one trade can more than cover a losing trade.
3 actually, yeah, it can cover
exactly.
like 3. Yeah.
So that's where you're working with probabilities, which now yields you a positive expectancy in the market, and that's how you sort of
the long run. Yeah.
Exactly.
Yeah.
So your the accuracy of your strategy and your stop loss and take profit, you tend to adjust them so that you have a positive expectancy in the long run. And if you have that, and if you have back tested it for some time, then you should be able to remove your emotions out of the trading, so that your trading is completely independent of how you feel, or basically how you feel about the markets. So the first thing to do when it comes now to, we've talked about the strategy, now we talk about the stop losses and take profits. And the first thing you need to know is, before you get into a trade, you need to already know where you're planning on exiting and where you're planning on taking profits. So this can be included in your strategy. So your strategy can have parameters for when to exit. Probably it's using an ATR or using support and resistance or order blocks or whatever. But it needs to include that parameter of, I'm risking this much in this trade, and this is where I'm going to exit. So once you know how far your stop loss or your take profit should be, that should in turn guide you on how large your lot size should be. Yeah. So your lot size is usually dependent on how far your stop loss should be.
Yeah.
Exactly. Then lastly, the next is place your stop loss within a reasonable distance from a technical barrier. Again, your stop losses should be where you place your stop loss should be guided by how the market is behaving at that point. Is it through market volatility? For example, if you're using Bollinger Bands or parabolic or support and resistance, or is it even guided by just the way the market is behaving at that moment? Yeah. So you should have a structure or a way of determining where your stop loss should be, and it shouldn't be a random process, because it's going to affect how frequently your stop loss is going to get hit. And then, so that a technical barrier in this case can be like a support and resistance, where a price might fail to go to the technical barrier in case the trade goes against you for some time before going for you. And then the last one is place a stop loss, a point where it will reasonably indicate that your trade is wrong. Yeah, so there are some instances where you'll get into a trade, you followed your strategy, but then it doesn't go for you. Then instead of exiting, you wait and see if the market is going to turn for you and go back in your direction. So this usually leads to a lot of huge losses, because sometimes it can be a news event and the market might never come back. So the best thing to do is you have the stop loss, a barrier where if that barrier is breached, then you know your trade is wrong and you can exit comfortably. And knowing how much you've risked in the first place, then it shouldn't stress you as much. And then the other one is not at a point determined primarily by the maximum dollar amount you're willing to lose. Yeah. So a lot of people just state or have it in their minds that I'm risking this much without necessarily looking at how the market is going to behave. So you need to consider all these factors coming into play into your strategy. So your strategy shouldn't just include where to enter and where to exit, but how far your stop loss should be, how far your take profit should be. Sometimes you might have a signal to enter, to buy, but then the risk reward, the stop loss distance and the take profit distance does not make sense. In this case, probably you'd be risking too much to make way too little. In that case, it won't make sense to take that trade. And that's how you filter some trades, even when your strategy is telling you this is a trade you can take. So I think I have examples. Today we had news in the morning from the Reserve Bank of New Zealand. I don't know if Edwin, you can allow me to share my screen.
All right, just 1 second.
Okay. Yeah, I think you need to make me the host.
There you go.
Okay. Okay. So it's visible?
Yes.
Okay, so I'll go to New Zealand dollar. So we had some news from the Reserve Bank of New Zealand in the morning, where it was an unexpected event where they raised their interest rates to 2%. So we had this spike up. So based on, if you're doing news analysis, then you'll know if something happens that is expected, then it shouldn't really move the markets. Yeah. So if there's a major reaction, chances are there's a high probability it's going to correct after some time. So we had this impulse move upwards when the interest rates came out in the morning. It was around 5. And then from here, we had a very good signal to sell the market, because you had this rejection over here. If I can zoom this. So we had sort of a rejection after this push up, and then we had a very bearish candle. But then if you are using your rules or your risk metrics, you'll know that I'll set my stop loss above the barrier. So the stop loss will be slightly above the barrier, somewhere here, or even slightly higher, because this down here is the barrier. So in the event that, even though you're right, sometimes the market might not necessarily move in your favor immediately. So it will have a point where the market might decide to take some liquidity, pull back a bit before now progressing in the intended direction that you had analyzed. So in this case, it gives you a good example of how you need to understand the concept of where you need to set your stop loss and your take profit. Because in this case, our barrier was at around 65,100, 0.65100. But because you know this is a barrier and prices might hit the barrier is usually a zone, then you set your stop loss some distance above the barrier, so that in case the stop loss is hit, then you know your trade is wrong for sure. But since sometimes the trade might go against you first before it goes for you, then the barrier comes into play to actually give you a reasonable level above it where you can place your stop loss. So this was one really interesting example from my end that I saw today morning. Edwin.
And that was a pretty big move. I noticed the same movement with Kiwi pairs, in particular Euro against New Zealand dollar. So
yes.
How many pips are those? How far did it stretch after the announcement?
So we had the announcement at around 5. So we had this push from here all the way to here to around 65. So that was around 84 pips. And then the pushback, prices came back to where they were before the announcement, as is the nature of such announcements. So yeah, around the same. This was around 74 pips.
Wow, it's quite big.
Yes.
Yeah, that was worth to consider. It's such a big move.
Exactly. So then in this case, we know that sometimes you might be okay with our analysis, only that the timing is wrong. So in that case, how you set your stop loss and take profit guides you or assists you in the event that you are right, but the timing wasn't right.
Okay.
Yeah.
Interesting.
Yeah, I think that's all I had from my end, Edwin.
All right. So that brings us to the end of today's session, and we are glad that you were able to join us. So tomorrow we'll have another session with our market analyst. So be on the lookout for that. session as well. And on Friday, we usually have Twitter Spaces, so you can as well join us then.
Yes.
Otherwise,
we have a
we thank
question.
you. Yes.
We have a question from the chat. Daniel is saying, what is the maximum lot size a person can use with a minimum deposit that is $500, I think. Oh, with a minimum deposit that is 500. I think that's around $5.
That is quite low. I think if I was in his shoes, I'd trade with the minimum. The minimum, with $5 you can only trade
very
a
few
micro lot.
instruments.
Yeah. Otherwise, anything above that, you'd be running a high risk.
Yeah. Also, the required margin for some instruments is around $8, $10.
Yeah. So in fact,
minimum.
you for some assets you might not be able to open a position because the required margin would be far much greater than the amount of capital that you have.
Yes.
So what I'd recommend him is to like add more capital over time. Daniel, take that as your first installment, and as you gather more money, you can keep growing your capital up to a level where you can be able to trade sustainably. Otherwise, $5 might be quite little for you to be in the market for long. Yeah,
because sometimes even with the stop loss that you're talking about, sometimes prices might go against you.
Yes.
So you don't want to receive a margin call because you're in some drawdown of some sort, even though you are right, maybe in the long term.
True.
I think that's it. Yeah.
All right. So that marks the end of today's session, and we thank you all for finding time to join us today. So we look forward to having you attending our upcoming sessions in the coming week. So we usually do this every Wednesday and Monday every week at 8 p.m. EAT. Yes. So yeah, so otherwise, we wish you all a very pleasant evening, and we look forward to interact with you in our future sessions. So see you all.